Hello students, welcome to financial accounting class. In the previous class we have dealt with different problems onto cost price method. In today's class we'll be dealing with the second method of consignment, that is invoice price method. Now what is this invoice price method? All of us have seen in the previous method, that is in terms of cost price method, the consigner sends the goods to the consignee at cost price, that is whatever expenses are being made. Let's say he has produced 100 units, and for each unit he is incurring an expense of 100. So in proforma invoice he will write it as goods sent at rupees, that is the cost price of the goods is 100. He will not add any extra amount of profit to it or so in case of cost price method. Now, in invoice price method, the consignee is unknown to what is the actual cost price incurred by the consigner. That is, suppose if the owner has incurred expenses of rupees 100 for producing the goods, he will not tell the consigner that what is the cost price of that. He will not tell what is the actual amount of expenses incurred or what is the cost price of the goods. Suppose if it is 100, he will write it as 200 and send it to the, that is the cost price, saying it that it is for 200, and send the goods to the consignee. Now what does the consignee do? He will see that the goods are received at rupees 200, the cost price, considering that the cost price is incurred at 200, and then he will add a amount of profit and then he will sell the goods. So here the consignee is unknown to what exactly is the expenses or what exactly is the cost price of the goods. So let's deal in what is the invoice price method. In invoice price method, the consignee is unknown to the actual amount of expenses or the actual amount of profit being made by the consigner, that is by the owner. So here the proforma invoice is prepared by adding certain percentage of profit to the cost price. Now what does this mean? For example, if the cost price of the goods is rupees 100, okay, for manufacturing, say let's say for manufacturing 1 unit, the expenses incurred by the consigner, that is by the owner, is say 10 rupees per goods. Okay, for manufacturing one product, his expenses is 10, that is the cost price is rupees 10. Okay, but then he will not say, he will, when he is sending the goods to the consignee, instead of sending this one product at rupees 10, he will say that he has incurred a cost price of 20. Okay, actually he has incurred 10, but then now he is saying that he has incurred rupees 20 as the cost price. He is adding that 10 rupees profit over here. 10 that is rupees 10 is the expenses, plus rupees 10 which is his profit. Okay, so altogether it will be 20. Instead of selling the goods at rupees 10, he will say that he has incurred a cost price of rupees 20. That is, the consigner will say that for manufacturing one product, he is incurring an expense of rupees 20 when he has actually incurred how much? Rupees 10. So here he is sending the goods at rupees 20 per unit. Okay, so the consignee here is unaware of what is the exact amount of expenses incurred on the product. Okay, for manufacturing the product, what is the exact expenses incurred on the product is not known to the consigner. So basically, what is this invoice price method? It here the consigner, that is the owner, sends the good to the consignee higher than the cost price. This is higher than the cost price because the expenses incurred are 10, and he is also increasing the he is also putting his profit of rupees 10. So he is sending the goods to the consignee higher than the cost price. He is adding certain percentage of profit to the cost price. Okay, and then selling the goods. Then sending the goods to the consignee. Now, what does the consignee do here? He will assume that the goods are the cost price of the goods is 20. So what again, at what price will the consignee sell? Let's say that 20 rupees is the cost price, okay, plus let's say 5 rupees is the profit. So the consignee will sell the goods at rupees 25. Okay, since the goods are sent at rupees 20 each, consignee will sell the goods at rupees 25, adding profit of rupees 5. Okay, so in total the consignee the consignor is adding the profit over here while sending the goods, plus he is receiving a part of profit when he is selling the good, when the consignee is selling the goods. Okay, so here the profit is doubled in case of invoice price method. Not exactly double, but a part of profit, more profit is there in terms of cost invoice price method. I hope you have understood what is invoice price method. I'll just read out once again for what is invoice price method. Invoice, here the proforma invoice is prepared by adding certain percentage of profit to the cost price. The consignee is unaware of the real profit. Okay, the consignee is not knowing what exactly is the amount of profit being what exactly is the amount of cost price being in cost of the goods. So he is not known exactly what is the amount of profit that the consignor is earning. Okay, next. Now here you have three different prices being involved. Invoice price is the price which is more than the cost price. Okay, the price which is more than the cost price is known as invoice price. So invoice price is equal to cost price plus the loading charges. Now what is this loading? Loading is the difference between cost price and invoice price. Okay, so loading is the difference between cost price and invoice price. Okay, what is this cost price? Cost price is equal to invoice price plus loading. Okay, when I solve the problems, you'll get to know it much better. For now, just remember that invoice price is the price which is more than the cost price, and in case of in case of loading is the difference between invoice price and cost price is equal to invoice price plus loading. Okay, you can just if you know this one particular formula, you can find out these two formulas. Okay, invoice price is equal to cost price plus loading. Okay, so loading is equal to invoice price minus cost price, and so on. The following are the comparative percentage. Remember this percentage, write down these percentage. That is 16 2/3 percent on invoice price, that is 1/6, which is equal to 20% on cost price, that is 1/5. 20% on invoice price, that is 1/5, is equal to 25% of cost price, that is 1/4. 25% of invoice price, that is 1/4, is nothing but 33 1/3 percent of cost price, that is 1/3. 33 1/3 percent on invoice price, that is 1/3, is nothing but 50% on cost price, which is half. 50% on invoice price, that is half, is nothing but 100% of cost price, which is 1. You just try to write down these formulas, this comparative percentage, and when I'm solving the problem, I will explain it much better. Okay, now since the goods are being sent higher than the cost price, now here the goods are being sent higher than the cost price. Actually the cost price is 10, but now they are sending the consignor is sending the goods at rupees 20. Okay, so there's a difference of rupees 10, Okay, since the goods are invoiced higher than the cost price, the figures will be inflating. You won't get the exact amount of what is the exact amount of profit or loss being made, because the consigner here is making secret profits. Okay, and that's how he is not telling the exact amount of he's not telling the exact amount of cost price to the consignee. Okay, so there will be fluctuation of amount, because the amount won't tally in case of the actual expenses made and the amount what the consigner is telling. Okay, so there'll be a fluctuation of or inflated results in terms of the figures, and that's how they have to get the accurate figures, to get the accurate result. Adjustments are to be made while closing the consignment account. Okay, so to get the exact amount of result, okay, the consigner has to make some adjustment while closing the consignment account. Now what adjustment he has to make? Adjustment like opening stock, goods sent account, then goods returned and closing stock. This is the adjustment that he has to make. In terms of opening stock, he has to make adjustment in terms of opening stock, in terms of goods sent, in terms of goods returned and closing stock. Now these are the following entries to be passed. Okay, now what entries will he pass for adjustment of loading in case of opening stock? Okay, so what is the journal entry? Stock reserve account debit to consignment account. Okay, adjustment of loading in opening stock. Okay, if there is this you will understand regarding the journal entries when I solve a particular problem. Okay, so for adjustment of loading in opening stock, what is the adjustment, what is the journal entry being passed? Stock reserve account debit to consignment account. Next, for adjustment of loading in goods sent on consignment account debit to consignment account. For adjustment of loading in goods returned, consignment account debit to goods sent on consignment account. And for adjustment of loading in closing stock, consignment account debit to stock or reserve account. Okay, so these are the four entries, that is the four adjustments to be made by the consigner. Okay, when it is adjustment of opening stock, adjustment of goods sent, adjustment of goods returned and adjustment of closing stock. As I told you, to get the accurate result, to get the accurate figures, what he has to do is the consigner has to make some adjustment in terms of opening stock, in terms of goods sent, in terms of goods returned and closing stock. So these are the journal entries for the adjustment being made. All right, we'll end with the class, and then in the next class we'll continue with a problem. Thank you.